Journal Trust here. The 2025 housing market is experiencing a significant slowdown in buyer activity due to four interconnected factors. So we have high mortgage rates and affordability challenges, right? The primary drivers of elevated mortgage rates in 2025 stem from macroeconomic pressures and policy dynamics. So the persistent inflation and Federal Reserve policy, despite cooling from 2022 peaks, inflation remains above the Fed's 2% target, right? 2.8% year over year as of, very recently of 2025, limiting the central bank's ability to cut rates aggressively. So the federal funds rate remains elevated at 4.25% to 4.50%, indirectly propping up mortgage rates, right? You have the treasury yield volatility. So mortgage rates closely track the 10-year treasury yield, which surged due to economic growth expectations and government borrowing needs. So this relationship keeps rates elevated even as inflation moderates. There's the fiscal policy and debt concern. So the US national debt, exacerbated by pandemic era spending and potential new tariff policies under the Trump's administration, increases borrowing costs for lenders who price these risks into mortgages. Now, market uncertainty is also expected, right? Anticipated policy shifts on trade and immigration create volatility, while the lock-in effect, which is the 80% of homeowners have sub 6% rates, reduces housing turnover, keeping upward pressure on rates for available inventory. Regional disparities and supply constraints, right? Construction activity remains uneven nationwide with limited affordable housing supply in high demand markets. This imbalance sustains price growth, 3.5% forecast for 2025, which indirectly supporting higher rates. Now, the number two in this, as far as the factor, is the supply constraints and market stagnation. So while inventory is increasing, right? New home listings at highest levels since 2007, the market remains frozen due to rate lock-in effect, right? 80% of existing homeowners have mortgages, right? The, less than or equal to the 100 basis points, below current rates, which is basically disincentivizing sales. There's demographic shifts. So an aging population, 7,000 baby boomers are dying daily. We want our baby boomers, right? But, it may eventually increase supply, but current turnover remains low. There's construction limitations, so new builds focus on luxury units rather than affordable housing. The third aspect is is economic and political uncertainty. So the Trump administration's immigration policies could paradoxically worsen, right, labor shortages in construction while reducing housing demand. Potential inflation from proposed economic policies might further pressure on mortgage rates. Fourth is the wealth disparities and market dynamics. So existing homeowners benefit from equity growth, enabling rate buy downs, while renters face stagnant wage growth relative to home prices, rising rents, reducing savings capacity, investor competition for limiting or basically limited inventory. So there are measures that you can take to increase that can be taken overall to increase affordable housing in 2025. So there's the federal funding expansion, right? The Biden-Harris administration's 2025 budget proposes the $185 billion in mandatory housing investments, including the $20 billion for an innovation fund for housing expansion to support local plans for increasing supply. So Donald Trump can probably do something similar to that. There's the $10 billion for first-generation homebuyer down payment assistance, targeting racial wealth gaps. There's the $22.3 billion for housing vouchers, targeting veterans and foster youth. $8 billion in homelessness prevention grants. Now, existing programs like the home investment partnerships and the CDBG are also prioritized to create or preserve affordable units. There's tax credit enhancements. So advocates urge Congress to increase allocations for 9% low-income housing tax credits to boost rental unit production, reform the private activity bond test to ease financing constraints, strengthen protections against premature exits from affordability agreements, the zoning and regulatory reforms, right? So key proposals include the federal incentives for localities to remove restrictive, zoning like single family only mandates, the categorical exclusions for HUD environment reviews on previously assisted properties. Then there's the transit-oriented development loans to encourage high-density housing near transit hubs. The preservation strategies with existing affordable units at risk, experts emphasize. Transferring project-based rental assistance to renovated properties without displacing tenants. FHA federal financing bank risk sharing to enhance preservation financing. Medicaid integration to fund support services in affordable housing. Market-driven solutions like you have the modular construction and smaller unit designs to reduce costs. Community land trust to maintain long-term affordability. State/local reforms allowing accessory dwelling units, also known as ADUs, right? And shared housing models. So that's what I have for you today. Please take a moment right now to hit the subscribe button and the like button. If you gain value, you appreciate this content, you want more content like this, let me know by hitting that subscribe button and the like button right now. See you in the next video.